I remember like in '09, it was a great deal. And I was able to put down 50% in cash, and I still had trouble getting a mortgage. And I had the financials. It was just a really tough time to get loans on investment properties. A lot of banks, a lot of lenders were shell-shocked. But a few years after that, with the advent of these DSCR loans and stuff like that, it made the financing get easier.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of Zon Investments, Tim Little. And on today's show, we have with us Steven Weinstock. Steven is a principal with We Capital. In real estate nearly 20 years, Steven provides secure long-term investment opportunities for private investors. Steven, welcome to the show.
Thank you for having me. Looking forward to this podcast.
Yeah, I'm looking forward to our little chat too. So we can definitely talk about We Capital in a bit, but I'd like to hear more about how you got started in real estate and how you got to where you are today.
Sure. So I started a little more than 20 years ago. I purchased a single family home. I'm born and raised in New York City. New York City is a market that is very tough to enter. And naturally, as a young whippersnapper such as myself, New York was out of reach. Did some research back then. The online research was not really out there. I reached out to a few people and friends of friends, different investors, and I settled on Trenton, New Jersey, which is about a 45-minute drive from where I live. Things there were easier to get into, and I purchased my first single-family home for $32,000.
Okay, and so that first home that you purchased, you weren't living in that one? That was purely for investment purposes?
Correct. Like I said, I was much younger. I was still living at home with my parents. I still had a job, and I purchased this property strictly as an investment property. My original plan was to buy just one property, keep it forever, pay off the mortgage over a 30-year period. And that would be my 401k, so to speak. That would be my retirement. When it was time to retire, I figured instead of selling the house I lived in, or whichever one I would live in, and downsize, I could sell this investment property fully paid off and use that for my retirement. That was my initial plan. After about 2 months of collecting rent, a lot of the numbers started clicking in my head. And once you're in it, you're in it. And I figured, why one? Let's go for two. And then two turned into three. And next thing, I was in a buying spree. Back then, financing on these types of properties, when I say these types, 1 through 4s, 1 unit to 4 units, they were pretty simple back then. The financing was easy and generous. And I was able to acquire quite a few in my first couple of years.
Yeah, so let's get into like how you were able to do that. Because I know a lot of people, they get skeptical because they look at maybe investing in real estate and they get told, all right, well, you have to have 25% down payment for anything that is a home you're not going to live in. Was that the case for you, or were you able to find some other more creative financing so that you could get it for less money in?
So on my first deal, again, this is 2001. Some of you remember, like I was saying, the financing was a lot easier. We were able to buy some of these properties with, besides the 20% down, some of these banks were allowing you as an investment to put 10% down. Some would even do 5%. Usually the loans would be more than one loan. It would be an 80 and a 10, an 80 and a 15. I've seen an 80, 10, and a 5 in order to do 5% down. So for this deal, it was 10% down. I put down about $3,500 for the down payment, paid some money in closing costs. I was in it for less than $5,000 out of pocket, and I was a landlord. Purchased this property, I had a tenant already in there, and I was in the game after that.
Yeah, and I'm sure a lot of people are listening right now and they're getting a tad bit jealous. Just that was even possible at one point, but as we know, it all came crashing down not too many years later, and I don't think we'll ever get back to that.
Correct. Obviously, like you mentioned, that way of financing ended in late 07, 2008, as a lot of these loans were over-leveraged. The properties were over-leveraged. You had a lot of people borrowing when they shouldn't be, people walking away from the properties. I self-managed these properties. I put my heart and soul into it. I had a pretty good criteria of what I could buy, what I can't buy. And even shortly after, before this crash of '08, I pivoted into a lot of creative financing. And the creative financing worked lots of seller financing, but a lot of seller seconds. I would get a decent 75% LTV loan, and the seller would carry, let's say, 15%. And again, I would put down a small deposit and was able to purchase quite a few properties that way. And seller financing became my friend. Tried it with a couple of brokers. A lot of brokers killed the deals. Sometimes they didn't understand it, didn't have it portrayed over to the investor, to the seller. And I focused on a lot of for sale by owners. And it was a numbers game. And I would always present multiple offers, usually with a seller financing component, sometimes with a very low ball regular offer in the hopes that it would start the conversation. And I had a lot of deals where the seller had zero inkling of what seller financing was. And after some back and forth and speaking to attorneys and me offering some attorneys as referrals, offering some other sellers where I was making monthly payments to on some other purchases as references, I was able to get a lot of deals that way, and that really was a big boom. And even to this day, in my multifamily career, I still try to get some sort of seller involvement into the deals.
Yeah, it's certainly nice if you can get it. And
Yeah.
so I assume back then, like you with the single family space, at least you were mostly dealing with distressed sellers. Yeah, was that the case?
When I first started, I didn't really know what distressed sellers meant. Even to this day, the deals that I were got into were sellers who I wouldn't say they were distressed as far as the property was vacant or behind on rent, or it was just a lot of older gentlemen. That was like the real bulk of my seller financing. You had these guys who owned the property for 25 years, lots of equity. They own a few properties in the area, and they were happy with a higher offer price. They were happy with some sort of tax deferral based on the closing, and some of the funds would come over the next couple of years. They really liked that. Sometimes the older investors really know how to appreciate the tax benefits of a seller financing deal. So again, I actually tried to stay away from deals that looked distressed from the outside, meaning I didn't like to do renovations. I didn't like to do the fix part of the flip. I really like to buy turnkey properties and add my aggressive management to the mix and try to make it work.
That makes a lot of sense. And I think it's something for people to remember, right? There's several different types of deals and ways that you can make them happen. There's, deals like I just talked about, like distressed, where, you're solving maybe a financial problem for them, something like that. But then there's also where maybe they're not financially in dire straits, but they like the idea of the tax benefits associated with being the financer, or maybe they want that more reliable income that comes with that, and they don't want to deal with management anymore of being that landlord. So it's all about finding solutions to problems, I think, at the end of the day, really. So let's fast forward a little bit, because honestly, we don't have a lot of people on the show who have been investing in real estate in any real capacity prior to 2008. So where were you at when the crash happened, and how did you fare during that?
Sure. So the first year or two, I focused on the single families. Then I pivoted really to the 2 to 4s, and that was my sweet spot for a real long time. I typically had fixed loans on these deals. I never really got into the variable, the floating rate type of deals, which really affected a lot of people back in '08 with the adjustable rates. I didn't really have too much trouble as far as 2008 with my properties. I did have a lot of trouble financing new deals during that process and even after that process. And I remember like in '09, there was a great deal and I was able to put down 50% in cash. And I still had trouble getting a mortgage. And I had the financials. It was just a really tough time to get loans on investment properties. A lot of banks, a lot of lenders were shell shocked. But a few years after that, with the advent of these DSCR loans and stuff like that, it made the financing get easier. But I really focused on the 2 to 4s, probably for a good 10 years or so. After that, I pivoted to some larger properties. 5 units plus, 8 units, 12 units, some mixed use, retail, office in New Jersey. I dabbled in Pennsylvania a little, in Philadelphia a little. I really had a bad time there, and I really did not do well over there. It actually turned me off of real estate for quite some time. And I remember after getting hurt over there, I put a hold on buying for, I would say, about a year and a half. I didn't sell what I had, but it really just turned me off. And this game is a long game, and I realized there was no way to make more money, at least with my skill set, in anything other than buy and hold real estate.
All right. And so with the once you moved up to the 2 to 4 unit, the small multifamily, were you doing most of those deals yourself? Were you doing like joint venture? What did that look like?
Good question. So here and there, I would have partners or investors, mostly for the down payment money to get in. These were always structured in different ways. Sometimes they were structured as really just a hard money with an interest only component and a balloon payment due after a set period of time that I wouldn't have to share in the equity. Some of them I brought in some friends and family over the years have always asked me about real estate. I brought them into the deals. I made some mistakes with the way I structured it. I would offer them too much equity for not a lot of the work. Basically, all the work fell on me. But it took me a while, a lot of trial and error to figure out which partners are the good partners and which ways to structure deals. And when I started, there was no biggerpockets.com and there was no online resource and there wasn't LinkedIn. And it was really just some books that I could find, but there wasn't a lot of material out there for me to network with. And a lot of my hard knocks come from experience.
Yeah, no, and you're absolutely right that the availability of knowledge and networking nowadays is such a huge advantage that I think people are a little bit spoiled. They don't realize what it was like prior to all this stuff being around. So tell me about the switch from, you talked about the evolution from like single family to small multifamily. At what point did you switch from the small multifamily to the to 5 and up, what we refer to as commercial multifamily? And what were some of the reasons that you decided to make that switch?
The properties that I owned in New Jersey for, I guess, the first part of my career, these were all self managed, for the most part, self owned. It was all me. I was the secret sauce. There was nobody else involved. I didn't have to really deal with anybody to get into these properties. I did want to scale up. I did want to buy apartments. I didn't know how. And a lot of networking, a lot of learning over this period of time. I took on a partner, a friend of mine, a guy who I did some deals with in the past. We work very well together. Our skill sets are literally totally opposites. What he's good at is stuff that I don't have the head for. What I'm good at is things that he would never dream of doing. And we really complemented each other in moving forward. And we searched out some markets. Being from the Northeast, New York City is just a very tough market. New Jersey is great, and I love New Jersey. Great appreciation there. But it was hard to get into the larger properties, very expensive. We came across a deal in Cleveland, Ohio, Cleveland suburbs, about 7, 8 years ago. And I know the area because I went to high school there. So when I heard this address, I knew exactly where it was and I could picture it in my head. And actually hopped over there, took a look at the property. I loved it a lot. Discussed it with this partner or potential partner. And we decided to create a partnership, reach out to all those people over the years who've always asked me about real estate and, oh, how could I get in or what could I do? I have some money, I want to invest. Created a structure for these investors, very defined. The terms and the roles were defined, obviously, in contracts and upfront. And we purchased this property. And after that, full speed ahead and on to the next.
Yeah, and that's really interesting. So I'm originally from Jersey, and the thing I'm thinking about is property taxes. Was that a big issue there? Because I know it was like even a long time ago, but I'm still hearing from folks that are in that area that property taxes in Jersey are pretty stiff.
Yeah, no, the property tax in New Jersey is, I believe, as a state, it's one of the highest, as an aggregate, one of the highest states in the country. I think Nassau County might be in Long Island, might be the highest in the country. But as far as a state, again, New Jersey is really out of control. I think it has to do with lots of renters and rental property. And if we could soak the landlords to pay for the public schools, which I think 80% of property tax goes to fund, let's get it from the investors. But yeah, the property tax was very high in that respect. On these investment properties, the purchase price had to fit in line for another investor to make money. Yes, but if I were to live there in a primary home, the property tax would be outrageous. But as far as investment property, it's definitely high, but it has to be in line with what another investor can take. So the answer is yes. On a $200,000 house, the property tax was $12,000, and a house in Brooklyn that cost $900,000, the property tax was $6,000. Yeah, it's definitely a lot higher over there. But that wasn't the reason I looked elsewhere. I think at this time you had a lot of Northeast investors getting sick of New York and making moves elsewhere. Obviously, Florida, Atlanta, the Carolinas started picking up with a lot of Northeast investors. And I guess I fancied myself a Northeast investor, and I looked at a few different markets. And when this deal came through in Ohio, it struck a chord because, again, I was familiar with the area, and I made it went to the top of my list, so to speak. And we took it down. We still own the property. It does great. The Cleveland suburbs, Cleveland area, cash flows very well. A lot of the Midwest, you do have some good cash flowing properties, sometimes at the expense of appreciation, but they cash flow well. And cash flow is important. Different types of investors, different types of buyers. Some people buy for appreciation, but I think that's more of a rich man's game. And I'm a blue collar working class guy, and the cash flow is very important to me.
Yeah, especially when it comes to apartments, right? It all comes down to the NOI, net operating income, for people who aren't aware. Because when it comes right down to it, apartments are a business. You run it like a business, they're valued like a business. So if you don't have cash flow, that's a really bad situation to be in. So if you can find ways to make it more efficient and increase that cash flow, drive down costs, that's where you make your money. Appreciation is a nice to have, the icing on top, but that's not how you're going to make most of your money on those types of deals. So you talked a little bit about Cleveland, and you mentioned that you still own that property. How long have you owned that first commercial property?
So that one is about 7 years or so, maybe a little more by now. Yeah, we purchased that in 2017 and purchased some other property nearby within the next couple of months. And then the following year, I pivoted a little to another market, Louisville, Kentucky. I've owned there the past 3 or 4 years. I really like that market as well. And I'm doing pretty well over there. And I would say my focus, Louisville now. I really like the market. It's great workforce, a blue collar market. A lot of jobs over there, essentially located in the US, and they just have a lot of factories and logistics and trucking. And if you remember, every Amazon package comes from Kentucky, or at least it used to until they got their own vans on the street. It's just essentially located within really about 60% of the U.S. population. It's a 2-hour flight. You can get to Maine, to Florida, to Minnesota, West Texas, all within a 2-hour flight from there. And these last 10, 15 years with all this e-commerce and trucking and deliveries, there's just a lot of blue collar action over there, a lot of jobs. And we have a vacancy, tons of leads just on Zillow for these properties, and we really like that market.
No, that's great. And you mentioned a lot of the fundamentals that I'm looking for whenever I'm looking at a market, right? You want to see population growth, you want to see job growth, and then for me, job diversity is a big thing too that sometimes gets overlooked, right? Because you don't want all the jobs to be concentrated in one sector, because if that sector goes away, then so does your entire tenant base. So it sounds that's a really good market for it, checks all those blocks. I guess the other thing I was going to ask is, what is your business plan normally with these properties? Because you mentioned having that one for 7 years so far. Are you looking mostly at, are these like 5 to 7 year business plans, 7 to 10? Or are you just holding on to them for as long as you can?
That's a good question. Every time I buy something, and really goes back to even 2001 and the smaller properties, I always buy it with the mentality to hold forever. Now, it doesn't always happen. I've sold plenty over the years. I have to fund my lavish lifestyle over here. So I've sold plenty. But when I buy the deal, when I get into the deal, It's always with the mindset to really own it forever. And obviously, some deals I have investors in, and that's a whole different ballgame. But I'll try to return the investor capital as soon as possible or as early as possible, whether it's 2 years or 3 years into the deal. During the good times, 2018, 2019, sometimes it could be 6 months. Sometimes you buy a deal in 2021, and next thing you know, 2022 hits, and you were hoping for 3 years, and it looks like it's going to be 4 or 5 years before the investor capital is returned. When I own a property with investors, LP, limited partners, I do want to get them their money back really as soon as possible. I have a lot of different types of investors, but I do have a lot of mom and pop investors, people who aren't real estate people. They have a job, they have a business, and here and there they have some extra money and they put it into a deal. Maybe they just don't like the stock market, or they've been burned by the stock market. Maybe they just like real estate. So I really want to get them their money back. I want them to be able to sleep at night. And even after I return the capital, they're still owners in the deal. They still have equity in the property. If I could get them their funds back, a lot of times they sleep better at night, and everything above that is gravy. And I could rinse and repeat with that money into another deal. And the best referrals I get are the ones that come after I return some capital to investors.
Yeah, of course. That makes a lot of sense. You talked about these different markets that you're in, be it Cleveland, Louisville, and I know you're in a couple other areas. And all of these are obviously outside of New York City. So, are you having to partner with operators so that someone has boots on the ground, keep a close eye on the property? And if so, what do you think is key to a good partnership? What are you looking for when you work for new partners for the first time?
Sure. So, just to go back, when I started out with the smaller properties, there wasn't a lot of money in the deal, so I was self-managing the property. So I really got a real education on just about everything, whether it's hot water heaters or tenants that have great stories as to why they're late on the rent, and really just all kinds of things. I'll give you a little story. The first tenant I ever put in, not one somebody who I inherited, but the first tenant I ever put in, it was a husband and wife. I put them into the apartment. I think they signed the lease on a Friday. I get a call from the wife on, I don't know, Saturday night, and she says that I think we have to move because my husband got arrested. So I said, "Oh my, what happened?" He says, "Oh, yeah, he got arrested for arson." So I said, "What? What? Where? What?" He said, "Yeah, the last apartment we lived in, he burnt down." And I'm like, "Oh." And so, ironically, she actually stayed with me for a couple of months, even though she told me she would leave. She stayed with me a couple of months. She paid me rent for those months. She was like, in a weird way, very honest. And
Yeah.
yeah, I'm going to pay, I'm going to pay. And she did. She paid me every month. I told her, no problem. Just give me 60 days notice. Tell me when you want to leave. Give me 60 days notice. Let me show it when we tell me you're out. And yeah, so that was a lesson learned with management back then, literally on my first deal. It didn't cost me money, but it really taught me how to read people when I meet them, and I guess do a deep dive on people. But so going back, so I managed these properties. I was full in, going down there all the time, all kinds of phone calls, all kinds of repairs, every kind of issue in the book. When it came to buying multifamily out of state, I wanted to manage these properties myself. And obviously, I live in New York. Most of my action is in New Jersey. How am I going to manage this? The bank that was giving me the loan wanted me to hire a third party management company. I didn't want to. I ended up working out with the bank where basically they would allow me to self manage. And it was a learning process also. Here I am 10, 12 years later or longer after owning real estate and having some newbie growing pains with long distance management. But we worked it out. We got a super to live in the building in lieu of partial rent. So that was the first step
Mhm.
to deal with that the so-called 2 a.m. Phone call for the toilet. And I hired full time a guy to manage the property. And the goal for that was to buy other properties where it would be more cost effective to have this guy. This guy was great. He was a local. He came from a referral. It wasn't just somebody I picked out in the book. It was somebody who used to work for another management company. So he had an idea of what's going on. Obviously, I would be literally on top of him. And I still am, by the way. He's great, and he's managing more units than he did when he started with me. A lot of my day is spent on management. It might be the wrong approach because my hourly rate of earn could be better if I focus on new investments. But I do self-manage these properties. I travel 2, 3 times a month. Sometimes I'm in and out the same day. Sometimes I stay overnight. But between Ohio and Kentucky, me and I, like I said, I have a partner, and we're managing these properties full time. It is a full time job. Don't get me wrong; it's tough, but I think with the kinds of properties that we own, which is Class C or maybe Class B minus if it's a good day and the appraiser is a nice guy. There's something to be said about self-management, mostly for the cost controls. Third-party management, I would say, is definitely something good to have on a Class A property where the complex was built 12 years ago and all the tenants are doctors and lawyers. But in Class C, Class B minus types of properties where it's a 70s vintage and there's lots of repairs, to be in control of those costs versus a third-party management company is key. And I see it when I look at new deals and I purchase new deals and I see the expenses put on by the third-party management company. I know that by self-managing, I'll be able to knock off some of those costs, and sometimes some of the profits or the upfront money that I can make is literally shaving some of those repair and maintenance items on the balance sheet. You could have a third party. You could have a water heater that's not working, and the third party management guy will just, okay, let's get a new one, and that's it. Or sometimes you could have a guy who self manages and will get his handyman out there to try to fix it. I haven't figured out which is the best approach, but if I could save a few dollars up front by tinkering with it and or having somebody tinker with it on my behalf, definitely makes me feel better. And again, I'm giving up some of my time for the cost control, but that's just the lane that I'm in. And for now, that's where I'm going.
Wow, well, more power to you. I have self-managed on just like a triplex, and again, Class C, just a higher level of management required for those tenants, right? They're not as self-sufficient. A lot of issues. Some are expected, some very strange and random, like you talked about. I've had everything from tenants getting arrested, and unfortunately, they were the only ones. So it just disappeared one day, and I was like, oh, okay, now what do I do? And then to bees in the bedroom. You can't make half this stuff up. Bees set up a hive in a windowsill of their bedroom, and you're like, oh, okay. So, you handle it. But you never know what to expect. So it keeps it exciting, but not something that I want to do on a day-to-day basis. So much respect for you being able to handle that. That was some great insight, and certainly a way to maximize cost savings, because I will certainly agree and attest to the multitude of just fees that start to pile up once you get into that third-party management space. And it really just comes down to the cliched, no one will take care of that property the way you will. And it's really just comes down to that. So if you're able to do that, it's certainly the best way to do it and maximize your money that you've invested in that property, and potentially your investors have invested in that property. So we do need to transfer to the turbo round now. So I'm going to ask you 3 questions that I asked every guest on the show, and I just asked for a quick, honest answer. Are you ready?
Go for it.
All right. First question. What is one red flag every investor should look out for?
Okay. Red flag. Okay, there's more than one. Maybe I'll cheat and give you a few, I hope. Okay, I'm afraid of environmental issues, mostly because I don't know about them and I don't have the headspace to know it and to deal with it. So when I hear some sort of environmental issue on the property or nearby the property, I try to stay away because I've heard some nightmares in the past, and I just don't want to be limited with whether it's my lender or the choice of lender because of that. Another red flag is I visit every property I buy. If I'm afraid to be there myself, during the day, I will not consider it. And at night, okay, it's a different story. But if I'm afraid to be there during the day, I stay away from that.
No, and I think both those are fair. Environmental, that's definitely something that could get very expensive very fast. When your due diligence, when you're going through that buying process, certainly something you want to look for. And then safety, not for yourself and for your tenants. That's a huge deal. All right, second question. What is a myth about this business that you would like to set straight?
Myth about the business I'd like to set straight. Okay. It's not easy. I know there's a lot of podcasts out there and TikTok out there. And I really, not that I watch it, but my kids have showed it to me and said, oh, Dad, why don't you just buy this? And I saw this on Zillow. It's not an easy business. It's a great business, and if you work it, you'll do very good. You don't have to be a genius to make money in real estate. The best thing for you in real estate is time. Time heals so many mistakes. And the first five, I've said this before, the first 5 years of owning a piece of real estate is the toughest. Your price is here, your rent is right there, and there's not a lot of wiggle room, and you're new to it, and you're dealing with it. You fast forward 5 years, and your purchase price is still here, and your rents hopefully are a little over here, and you start making some nice money. If you own it 5-10 years and you're doing well, the real wealth, in my opinion, comes in 15 years plus. So I know we spoke about what's my target hold. If you could own a property for 15 years plus, 20 years plus, that's wealth. It's really a game changer. It's money you could pass down to your family. All the big New York money is building owners that their grandparents bought years and years ago, that they bought with some extra money from when they worked in a factory or whatever. And now their grandkids are sitting on the top of the ivory tower, refinancing some deals here and there. And so owning it a long time is really where the money is. Yes, there's money in flips, there's money in rehabs, but it's not an easy business. So it's not easy. I would say though, get in always. It's always a good time to buy. I don't believe I'm sitting on the sidelines. Yesterday was the best time to buy. Today is the second best time to buy. Buy the deal, make sure it pencils out, and maybe it'll take a year or two. Make sure you could afford it. Make sure you could put down a bigger down payment if you have to. Leverage the property less, but it's not an easy business.
Yeah, definitely time in the market rather than trying to time the market. Just like with the stock market, real estate is not different in that respect, right? The sooner you start investing is the sooner you can capitalize on that time. And I think the other takeaway that I had is you're telling me I can't trust all the financial advice that I hear on TikTok. So I'm going to have to write that one down. All right, last one. What does success look like to you?
Okay, so this has changed over the years. Originally, when I first got in, success was owning one piece of property and waiting it out for 30 years until it's paid off. Over the years, it's changed into having enough money for myself, having enough money not to have the so-called corporate job. Success for me is to have as much time as I need for my own, when I say my own, my family. I'm working a lot. I work a lot of hours, but I'm able to not miss my kids' events, or I'm able to utilize the time how I want. I spend a lot of hours working, but if I gotta do something for the family at 11 a.m. on a Monday, I could, for the most part, easily take care of it. And at this point in my life, success to me means providing for my family, having time for them, and making sure that they could have what they need. Nobody's spoiled, but nobody's starving either.
Yeah, exactly. The time freedom, that financial freedom, and yeah, they're not spoiling. I'm still working on that. I want to make sure my girls don't grow up spoiled. All right. Hey, Steven, this has been awesome. I really appreciate you coming on and talking to us, especially with your long and storied background. Please tell our listeners how they can get a hold of you and if there's anything else you'd like to share with them.
Sure. So Steven Weinstock, We Capital. Website, wecapitalx.com. I'm on LinkedIn. I'm pretty active over there. I do have an Instagram. I'm not too active there, although my kids tell me I need to be. We'll try to put some stuff up over there. In general, I'm looking for property, multifamily property in Louisville, Kentucky, Cleveland suburbs. My buy box is 50 units plus. I am not an institution, so I'm not just buying deals every month. I'm able to pick and choose my deals, and I'm able to bring them to my investors, see what they say about the deal, and try to get them on board into the deal. I do spend my days, like I said, managing property, finding new deals, traveling to the property, reaching out to the investors, trying to find new investors, and my highlight is doing a podcast.
There you go. All right, Steven. Hey, thanks again for coming on. We'll definitely have all that information in the show notes, but I appreciate you coming on and look forward to continuing to see you do big things on your journey to multifamily millions.
Thank you.